Traditional heavy infrastructure is notoriously volatile. A firm lands a massive contract, scales up labor, finishes the build, and then hits a hard stop until the next bid clears. It is a high-revenue, low-margin cycle, dependent entirely on securing the next one-off project. SOL Energy operates entirely outside of this cycle as a pure-play infrastructure provider for solar and BESS installations. BESS stands for Battery Energy Storage Systems, which are large-scale lithium-ion arrays that store excess renewable energy for later use on the grid. SOLV's revenue grew rapidly. In 2024, they brought in $1.84 billion. By the end of 2025, top line scaled to $2.49 billion, a 35% increase. On that same timeline, adjusted EBITDA doubled to $342 million, pushing gross margins to 18.6%. Expanding margins in heavy construction usually signals a temporary macro boom. However, SOL utilizes a life cycle economics model. They convert these massive, capital-intensive construction projects into 35-year recurring revenue annuities. The core evidence for this model sits in their backlog, which reached $8.0 billion by the end of 2025. In institutional finance, backlog consists of highly secured, contracted future revenue, where the scope and pricing are already defined. Most traditional construction firms operate with order books that stretch out 12 to 18 months. SOLV has locked in deep, multi-year visibility. To understand how an $8 billion backlog is engineered, we have to isolate and deconstruct the unit economics of a single utility-scale project. Every installation begins with the EPC phase. EPC stands for Engineering, Procurement, and Construction, encompassing everything from initial site modeling to securing materials and executing the physical build. Controlling this initial EPC phase is the required catalyst. Winning the build secures the compounding, multi-decade revenue that drives its valuation. This chart tracks U.S. power grid load growth. After years of relatively flat historical energy demand, the requirement for new power has suddenly diverted into a 5x upward trajectory. That sharp vertical climb is driven by three intersecting pressures: the rapid expansion of massive data centers, the intense power requirements of artificial intelligence training models, and the broad reshoring of domestic manufacturing facilities. The grid is immediately constrained. Traditional power generation facilities like natural gas and coal plants have permitting and construction timelines that are simply too slow to meet this near-term spike. Utility-scale solar and battery storage systems solve this bottleneck. They are currently the lowest-cost forms of new power generation available, and they deploy far faster than fossil fuel alternatives. Average build rates for solar and BESS installations have scaled to nearly triple their historical averages to catch up with the energy shortfall. To actually impact the grid at this level, developers are commissioning massive, complex installations that exceed 200 megawatts of capacity. A megawatt is equal to 1 million watts of electrical power. This specific demand environment creates a concentrated funnel. It heavily favors a contractor with the specific engineering capacity to execute infrastructure at an extreme utility scale. Constructing a solar and storage site that generates over 200 megawatts requires a staggering physical footprint and immense logistical coordination. The core of the EPC phase is the design and build. This involves modeling the site, procuring the heavy equipment, driving structural foundations into the earth, and routing miles of high-voltage electrical cable. By managing this entire integration process, SOLV captures 40% or more of the total capital a developer spends to bring the site online. The operational barriers are steep. A lead contractor has to secure SBOS, or structural balance of system, which refers to the racking, trackers, and mounting hardware that hold the panels. They must also procure massive commercial inverters and execute complex high-voltage substation connections. These are highly technical, engineering-heavy requirements. They form a protective moat that prevents new entrants or smaller regional construction firms from bidding on these megaprojects. Controlling these exact bottlenecks allows leading EPC firms to convert their revenue into free cash flow much more efficiently than other companies sitting in the renewable energy value chain. The EPC phase generates significant upfront cash flow, but its primary strategic value is acting as an exclusive funnel. Winning the initial build guarantees the rights to service the asset for decades. This chart breaks down the total lifetime spend of a typical photovoltaic and BESS project. Over a standard 35-year lifespan, the total economic opportunity is roughly $1.19 per watt DC. DC stands for direct current, which is the standard measure for the maximum capacity of a solar panel array. The upfront EPC construction contract captures approximately 82 cents of that total lifetime value. The project continues well past commissioning. For every single watt installed, there is a remaining 37 cents of long-tail revenue, stretching across the next 35 years. The baseline of this tail is preventative maintenance. These are 5-year, auto-renewing contracts that account for roughly 20 cents per watt. Then come the predictable, mandatory inverter replacements that occur midway through the project's life cycle, which account for another 10 cents. The final 7 cents comes from major corrective maintenance events, covering things like emergency repairs for hail or wind damage. This unit economic structure converts a single, heavy capital construction event into a compounding 35-year recurring revenue annuity. When you pull back from a single site and look at SOLV's historical execution across the national grid, the scale of this annuity becomes clear. SOLV currently has over 20 gigawatts of capacity under management. A gigawatt is equal to 1 billion watts. This portfolio represents a 2.2x increase in managed assets since 2020. Because their engineers originally designed and built these complex systems, SOLV holds a severe structural advantage. They are the default low-friction choice for the developer's operations and maintenance, or O&M, contracts. This chart breaks down the future cash flows trapped inside their physical installed base. It reveals a $7.4 billion embedded revenue opportunity, $3.9 billion in preventative maintenance, $2.1 billion in inverter replacements, and $1.3 billion in corrective maintenance. That $7.4 billion exists entirely within their operating portfolio today. It is locked in, completely independent of any future construction bids they might win. This creates a compounding multiplier effect. Every time SOLV finishes a build, they recognize revenue for the year and geometrically expand their captive market for the next 3 decades. This pie chart re-examines the $8.0 billion backlog from earlier, now contextualized by this annuity model. It is composed of 68% signed EPC contracts, 25% signed O&M agreements, 4% awarded EPC, and 3% estimated corrective maintenance. The primary risk factor institutions model for this sector is regulatory, specifically the threat of legislative shifts or the rollback of federal renewable energy subsidies. SOLV's defense mechanism is entirely contractual. 100% of their December 2025 backlog is tied to safe-harbored projects. These are sites that have already met the legal threshold to strictly qualify for existing tax credits, regardless of any new legislation drafted tomorrow. That safe harbor status effectively insulates their near-term revenue generation from macro-political volatility. And the upside extends beyond standard maintenance. They capture high-margin repowering projects, bolt-on battery additions, and T&D, or transmission and distribution upgrades on their existing sites. The strategy relies entirely on physical execution. Controlling the high-barrier EPC construction choke point is just the customer acquisition cost to secure a multi-decade servicing market. SOLV Energy constructs massive power infrastructure. The per unit economics dictate a different reality. By converting heavy construction cycles into long-tail recurring revenue, they have engineered a highly predictable, compounding financial growth engine.